Are you interested in finance? Want to understand what's happening in Belgian corporate finance? Dreaming of breaking into investment banking, M&A, or private equity? Then The Finance Show is for you. Every 2 weeks, we break down the most important corporate finance news in Belgium and around the world. We bring you expert insights, career advice, and the stories behind the deals that shape our economy. Whether you're a student looking to break in, a professional staying sharp, or simply curious about the world of finance, this is your access point to Belgian corporate finance.
Hi everyone, and welcome back to The Finance Show, Belgium's podcast for corporate finance news, insight, and career guidance. The goal of this show is simple. We take what's happening in Belgium and global corporate finance and we make it accessible, relevant, and useful. Whether you're a student trying to break into the industry, a professional wanting to stay sharp, or just someone curious about the Belgian business landscape. And today, I'm joined by Manon, who will be asking the questions that are on your mind too. This is our third news episode, and we've got a packed one for you today. We're covering 4 stories. First, we look at Loop Earplugs, the Antwerp scale-up behind those design-driven earplugs you have probably seen everywhere. They just raised 50 million euros in a deal that's a masterclass in capital structure thinking. Then, we move to one of the biggest potential IPOs in Belgium corporate history. Belron, the parent company of Carglass, which could be heading to Wall Street at a valuation of up to $40 billion. Third, we go through the Belgium M&A league tables for 2025, who closed the most deals, who advised on the biggest transaction, and what it all means if you're trying to break into the industry. Finally, our global story, the cracks appearing in private credit markets, why some of the world's top investors are drawing comparison to 2008, and what's actually at stake. Lots to get through. Manon, let's get into it.
Hi Maxime, thank you for the invitation. I'm happy to be here. Let's start with the first news.
All right, indeed, let's start with the first story, close to home. Loop Earplugs, the Antwerp-based scale-up, and they just raised 50 million euros. And the way they structure this deal is really interesting from a corporate finance perspective. But before we get into the numbers, let me give you some background, because this company's growth story is remarkable.
Yeah, Loop is a name I keep hearing more and more, even outside of finance circles. Can you set the scene on who they are and how they got here?
Loop was founded in 2016 by Dimitri O and Martin Baudoues. The idea was simple but sharp. Hearing protection had always been treated as a purely functional industrial product. Think of the ugly foam earplugs that you get at a concert. And Loop came and said, what if hearing protection could actually look good? What if people wore earplugs the way they wore sunglasses? Different products for different moments: music, sleep, work, etc. That repositioning was everything. It turned a commodity product into a lifestyle brand, and the market responded well. They've now sold over 22 million products worldwide, and revenue went from 1.2 million euros in 2020, so just 6 years ago, to over 200 million euros today in 2025. And they've been profitable since 2021. For a Belgian scale-up, that trajectory is exceptional.
That's an incredible growth curve, 1.2 million euros to 200 million euros in 5 years. So, why raise 50 million euros now? Is this a sign they're under pressure or is this something else?
Great question, thank you. And the answer is because they don't need money to survive. They need it to accelerate. There is a difference. This is growth financing, not rescue financing. The round has 2 parts. 30 million euros comes from bilateral credit facilities, so that's direct loan agreement with their existing banking group, and 20 million euros comes as a convertible loan from KPMG, the Flemish public investment company that we already talked about last week. These are 2 different instruments, and it's worth understanding both. The bank debt is straightforward. Loop borrows, Loop repays with interest. Clean and simple. The PMV convertible loan is more nuanced. It starts as debt, PMV lends 20 million to Loop today, but PMV has the option to convert that loan into equity at a later stage at a pre-agreed valuation. So PMV gets downside protection as a lender, but also upside participation if Loop keeps growing. For Loop, it's a way to bring in a strategic investor without immediately giving up ownership. Smart on both sides.
The articles don't name the banks behind the 30 million euros facility, but do you have a sense of who might be involved and what kind of debt structure this actually is?
Good question. And to be clear, none of this is confirmed yet, but we can make some educated guesses. For Belgium scale-up of this profile, you would typically be looking at the usual suspect in the Belgium corporate lending market. BNP Paribas Fortis, KBC, ING Belgium, and Belfius. These are the four banks with the deepest relationships in the Belgium mid-market. That's the realistic lending group for a company of Loop size and geography. On the type of debt, the 30 million euros bilateral facility is most likely a revolving credit facility or a term loan, or even a mix of both. A revolving credit facility works like a corporate credit card. You draw down what you need, repay it, and draw again. Very flexible and ideal for a company funding working capital and expansion without committing to a fixed repayment schedule. A term loan is more rigid, fixed amounts, fixed repayment, and fixed timeline. Given that Loop is using this for ongoing growth investment rather than a one-off acquisition, I would lean toward a revolving structure. But again, this is speculation on my part. The official terms haven't been disclosed.
And what's interesting is they specifically avoided a traditional equity raise entirely. For a company at this scale, that's quite an unusual choice, isn't it?
It is, and this is the part I find the most interesting. Loop has only raised 800,000 euros in equity in its entire history, two small rounds in 2020, and that's it. Now, with 200 million euros in revenue and solid profitability, they could have gone to a VC or a private equity fund and raised 50 million euros in straight equity tomorrow. But they choose not to, and you might ask why. Dimitri O said himself, why this choice? Because we can. And obviously he's right. When you're profitable and generating strong cash flows, debt is almost always cheaper than equity. You don't dilute your ownership, you don't bring in outside shareholders who want board seats and exit timelines, and interest costs are tax deductible, meaning the government effectively subsidizes part of the borrowing cost. This is textbook capital structure thinking. The academic term is the tax shield on debt that you might have seen in your finance classes. Use it when you can afford it. Loop can afford it, so they did. For student listening, this is exactly the kind of reasoning you want to be able to articulate in an interview when someone asks you about financing choices.
Right, and that tax shield argument is something that comes up a lot in interviews around capital structure. So, from a valuation angle, how do you actually put a number on a company like Loop?
It's generally complicated because Loop sits between two walls. They're not a pure consumer goods company anymore, but they're not quite a tech company yet either. They're actively positioning themselves towards technology with the new SenseWare concept, the idea that user can choose how they perceive sound depending on the moment. So how do you value it today? If you apply a revenue multiple, which is standard high growth consumer brands at 200 million in revenue and a modest 3 to 5x multiple, you land somewhere between 600 million euros and 1 billion euros in enterprise value or EV. That's already a significant number, but here is where it gets interesting. If Loop successfully transition into a tech-enabled, recurring revenue model, those multiples could expand dramatically. Software and tech businesses can trade at 8, even sometimes 10x revenue. If Loop's valuation keeps climbing and PMV converts, that's a strong signal from a well informed insider that they believe in the long term story. That conversion decision will tell you more than any press release. That's the number I would follow.
Okay, thank you. We'll follow that in the future. Now that we've closed the first news, what's the second one about?
Alright, the second one is a big one, potentially the most significant Belgian corporate finance story of 2026. We're talking about a potential IPO of Belron, the global repair and replacement company and the parent company of Carglass as you know it in Belgium. The numbers being thrown around are staggering. We're talking about a valuation between 30 and 40 billion dollars. Let's break this down properly.
Before we get into the IPO mechanics, can you give us a quick picture of what Belron actually is as a business? Because I think a lot of people know Carglass but don't know the group behind it.
So Belron is the global holding company. It operates in 40 countries, employs around 30,000 people, and owns several brands depending on the market. Carglass in Belgium and much of Europe. Safelite in the United States, which is actually their biggest market. Autoglass in the UK. O'Brien in Australia. And the business model is straightforward but incredibly sticky. You crack your windshield, you call them, and they fix or replace it, often covered by insurance. So, low customer price sensitivity. It's a phenomenal business from a fundamental standpoint, and the financial back that up. In 2025, Belron posted a record adjusted operating result, up 15.7% year on year, with an impressive margin of 23%. That's exceptional for a service business at this scale.
So, who actually owns Belron today and why is an IPO suddenly on the table?
This is where it gets interesting from a corporate finance perspective. D'Ieteren Group, the Belgian holding company, owns 50.3% of Belron, so just above majority control. The rest is held by a group of financial investors. Clayton, Dubilier and Rice, which is a major American private equity firm, Hellman and Friedman, another large US PE fund, GIC, the sovereign wealth fund of Singapore, and BlackRock. These are serious, institutional long-term investors, but they're also investors who at some point need an exit. That's the nature of private equity, and when you look at the valuation trajectory, D'Ieteren sold a 40% stake to Clayton Dubilier and Rice back in 2018 at an EV of $3 billion. Today, the number being discussed is $30 to $40 billion. That's roughly a 10x increase in less than 10 years. If you're a PE fund sitting on the return, you want to monetize. That's the pressure driving this.
And that's where Rothschild comes in, right? D'Ieteren has formally hired them to explore options.
Exactly. Bloomberg broke the news that D'Ieteren has mandated Rothschild to explore strategic option for its stake in Belron. And this is worth pausing on, because the role of an advisor like Rothschild in this context is very specific. They are not just running numbers. Rothschild is being asked to map out the full option set. That includes a full IPO, as you know it, a partial IPO where only a slice of shares get listed, a secondary sales to another financial investor, or potentially a strategic sale to a corporate buyer. Their job is to stress test each scenario. What does each option mean for valuation, for control, for tax, for market timing? Everything has to be considered at once. They also manage the relationships with the other shareholders, coordinate with potential banks that would underwrite the IPO, and at the end, present a recommendation to the board. For a transaction of this size and complexity, that advisory role is critical, and Rothschild is one of the top independent advisory firms globally for exactly this kind of work.
So, if an IPO does happen, where does it list? Europe or the US?
This is one of the most debated questions right now, and my view is pretty clear. I think the US is the more likely destination. Here is why. First, Belron generates more than 50% of its revenue in the US through Safelite. US investors will naturally understand and value that business better. Second, US equity markets historically apply higher valuation multiples to services business than European markets do. A $35 billion valuation is more achievable on Wall Street than in Amsterdam or Brussels. Third, and this is a detail worth noting, Belron CEO is Carlos Brito. He was the long-term CEO of AB InBev, one of the most sophisticated operators in global consumer goods. He knows US capital market extremely well. That context matters when you're deciding where to list. The Financial Times also mentioned Amsterdam as a possibility, and Bloomberg kept both options open.
And what does all of this mean for D'Ieteren as a shareholder? Because the stock has been very reactive to every piece of news on this.
Indeed, reactive is the word, and that's for a good reason. D'Ieteren stock jumped over 6% the day Bloomberg published their article, and it's up over 20% year to date. The market is essentially pricing in the IPO as an unlock event. Here is the logic. If Belron lists at $35 billion, D'Iteren's 50.3% stake is worth roughly $17 to $18 billion. That's a huge amount of value that is currently locked inside a private company. Once Belron is listed, that value becomes liquid, visible, and tradable. D'Iteren has been clear they intend to remain a majority shareholders after the IPO. They are not selling out. But even retaining control, the transparency that comes with a public listing re-rates how the market value D'Iteren itself. My personal take is that I think the IPO will happen, but maybe not in 2026. There are two blockers right now. First, the debt level. Belron's leverage ratio sits at 4.5x adjusted operating profits. The CFO of D'Ieteren has said publicly that for a successful IPO, they want that ratio closer to 3x. Getting from 4.5 to 3 takes time, even with a strong cash flow generation. Second, market condition. We're in a volatile macro environment right now. Investors are selective, and you don't want to launch a $35 billion IPO into uncertainty. You want a clear window with strong investor appetite. My base case is that if conditions stabilize and the deleveraging continues on track, you're looking at a 2027 listing at the earliest.
So, for students following this, what's the key takeaway from a corporate finance perspective?
A few things. First, understand the difference between a primary and a secondary IPO. In a primary IPO, the company issues new share and raises fresh capital on the markets. In a secondary IPO, existing shareholders sell their shares and pocket the proceeds. Belron's IPO would likely be secondary. The PE shareholders want liquidity. Second, watch the leverage ratio. The 3x target that the CFO mentioned is not just a number. It's a signal to public market investor that the balance sheet is clean and sustainable. High leverage scares public investor, especially in a rising rate environment. Third, the choice of listing venue is a real strategic decision with real valuation consequences. US versus Europe is just not a geography question. It's a multiple question, an investor based question, and finally, a liquidity question. If you want more insight about how the liquidity can be different between Europe and US, I would advise you to go back to our previous podcast. These are exactly the kinds of topics that comes up in investment banking and private equity interviews. So it's better if you know them by heart.
That's it for Belron. Very interesting. Should we move to the M&A league tables?
All right. Third story, and this one is a bit different. No deal announcement, no IPO, no rumor, but instead, we're looking at the Belgium M&A league tables for 2025, published by Dealmaker Data. And I think this is actually one of the most useful segments we can do for student listening, because understanding league tables, what they mean, and who the players are is really important knowledge for anyone looking to break into finance.
Let's start with the basics then. What exactly is a league table and why does it matter?
A league table is essentially a ranking of advisory firms based on their deal activity over a given period. You can rank by number of deal closed or by total deal value, and those two rankings often tell very different stories. A firm that closed 70 small deals will rank very high by volume, but may not appear at the top by value. A firm that advised on a very large transaction, such as Belron, as just discussed, will rank very high by value, but may only have a handful of deals. Both metrics matter. They just measure different things. Volume tells you about market coverage, and value tells you about where a firm sits in the market, mid market, large cap, or mega deals. You might wonder why league tables are so important. For firms, they're a credibility and marketing tool, and when they pitch for a mandate, you show your league table ranking to demonstrate track record. For clients, they're a shortcut to identifying who the active, experienced advisors are. And for you, students and listeners, knowing these rankings tells you who the key players are in your market, which firms are most active, and where would you get the most deal exposure if you join them.
So, who came out on top in Belgium for 2025?
Let's go category by category. In M&A advisory and financial due diligence, which is the core advisory category, BDO topped the rankings by number of deals, closing 77 transactions with a total deal value approaching 200 million euros. FinVision was right behind them with 67 deals. These are not bulge bracket investment banks. BDO is a large accounting and advisory network. Think audit, tax, and transaction advisory under one roof. FinVision is a boutique M&A advisor focused on the Belgian mid-market. The fact that they dominate by volume tells you that Belgium M&A market is a mid-market ecosystem. Lots of smaller deals, owner management businesses, family company transaction. That's the reality of Belgium corporate landscape.
And if we look at deal value, does it look different?
By deal value, KPMG Belgium leads with 2.75 billion euros in completed transaction, followed by 8 Advisory Benelux with 2.17 billion euros, then EY Belgium at 1.44 billion and PwC Belgium at 1.1 billion euros. So when you look at the value, the big four dominate, and that makes sense. KPMG, EY, and PwC, these firms have the resources, the sector expertise, and the global networks to handle large, complex transactions. Their transaction services division are serious operations. The standout deal for KPMG was advising shareholders of Clarabot Potatoes on its acquisition by Simplot, an American food company, for over $1 billion. That was one of the largest Belgian transactions of the year. 8 Advisory is worth highlighting specifically because they're less well known. They're a European financial advisory boutique originating in France, now with a strong Benelux presence. They focus purely on transaction services, FDD, so financial due diligence, valuation, restructuring advisory, and so forth. No audits, no tax, just deals. Their notable transaction in 2025 was providing due diligence to Bensis Capital Partners on the sales of Equine Care Group to CNP, a deal that won recognition at the M&A Awards Belgium.
What about legal advisory? Because that side of the table often gets less attention, but it's equally important in any deal.
Absolutely, and it's a different market structure. In legal advisory, BDO Legal leads by volume with 36 transactions. Cresco Law and Argo Law follow with 16 and 14 deals respectively. These are all Belgian-focused law firms operating primarily in the mid-market. But by deal value, the picture shifts again. A&O Sherman dominates, and that should come as no surprise. A&O Sherman is one of the largest global law firms. They advise on mega deals. Their standard transaction in Belgium was advising Ageas' acquisition of Azur, the British insurance company.
And finally, private equity. What does the PE side of the table look like?
Yes, most interesting for the end, private equity funds. GIMF and PMV share the top spot with 18 transactions each, followed by Fortino Capital with 11 investments. Now, these are three different companies. GIMF is a listed Belgian private equity firm, publicly traded on Euronext Brussels, and investing across Europe in healthcare, smart industry, consumer, and sustainable cities. PMV, which we already mentioned in the Loop segment, is the Flemish Public Investment Company. It's a government backed company with a mandate to support Flemish companies and the broader Flemish economy. Finally, Fortino Capital is a more recent player. This is a Belgian growth equity and buyout fund focused on B2B software and technology companies in the Benelux. Smaller in scale, but very focused in terms of sector.
For students listening, what's the actual takeaway here? What should they do with this information?
Know the market you want to work in. If you're interviewing for an M&A role in Belgium and you can't name the active advisor, the recent market deals, and the key deal makers, that could be a problem. League tables are the fastest way to build that picture. Interviewers notice when a candidate actually knows the landscape.
Thank you. That was the last story for the Belgian market. Now we're moving to the global story of the week.
Indeed, we're talking about private credit here. Cracks are starting to appear in a market that was sold to investors as safest, most reliable source of returns in modern finance. And this story has been building for weeks and even months now.
Private credit. I feel like everyone's been talking about it for years, but not many people actually know what it is. Can you break it down?
Absolutely. So, private credit is lending that happens outside of traditional banks. Instead of a company going to a bank for a loan, for example, it borrows directly from a private fund. These funds raise money from investors, deploy it as loans, mostly to small and mid-sized businesses, and then collect interest. The pitch to investor was simple. Double-digit returns, some funds were promising 11, even 16% annually, no public market volatility, stable predictable income, and it sounded almost too good to be true. And as we're finding out, it could be. The market exploded to around $3 trillion globally, and a huge chunk of that money came from retail investors, ordinary people like you and me, whose pension plans were quietly allocated into these products without them fully understanding what they actually were.
So, what's actually going wrong?
It started with Blue Owl Capital, one of the largest credit managers in the US. In February, they announced a fire sale of $1.4 billion of loan assets to fund redemption requests from investors who wanted their money back. And here is the important detail: they still couldn't satisfy all the requests. Therefore, they capped withdrawals at 5% of the fund per quarter, while investors had asked to pull out nearly 11%. So that's a huge difference. More than half of the redemption requests were just simply denied. Then, New Mountain Finance followed, selling assets at a 6% discount. Morgan Stanley Private Credit Funds revealed it couldn't meet redemption either. And the last one was JP Morgan, disclosing rating downgrades on loan in its private credit portfolio. Like that, one by one, the dominoes start falling.
That withdrawal cap is something I didn't know funds could even do. Can you explain how that works?
Right, and this is the heart of the problem. These funds are what's called semi-liquid. Unlike a traditional private equity fund, where your money is locked up for 10 to 12 years, a semi-liquid fund lets you request withdrawals quarterly. Sounds flexible, right? But there is a mismatch. The fund lends money to companies on 5 to 7 years timelines. Those loans are often illiquid, as you can sell them overnight, but the funds promise investor quarterly access as long as new money keeps flowing in and only a few investors want out. The math works. But the moment confidence cracks and everyone rushes for the exit at once, the fund simply doesn't have the cash for that. So it either sells assets at a discount, like Blue Owl did, or it closes withdrawals. They basically say to investor, sorry, but this quarter it won't be possible.
And you mentioned this feels familiar. Are people actually drawing 2008 comparisons?
Indeed, they are, and these aren't just not random comments. Danny Moses, the asset manager who inspired one of the characters in The Big Short, has said publicly this reminds him of the pre-2008 period. In 2008, banks were packaging subprime mortgages into complex products, rating them as safe and selling them to people who didn't understand them. Does that sound familiar with the story I just told you? When the underlying asset defaulted, the whole thing collapsed. Today, private credit funds are packaging illiquid loans into semi-liquid products, promising returns and access that don't actually exist, and selling them to retail investors and pension funds.
And there's an AI angle to this as well, right?
Yes, and this could be the catalyst of a huge crisis. Private credit funds have very heavy exposure to software sector. Software companies were the perfect borrowers for years, recurring revenue and high margins. But AI is now disrupting that business model at speed. Companies that had stable revenue stream are suddenly facing existential questions. UBS has raised its worst case default forecast for private credit from 13% to 15%. When borrowers start defaulting, loans become worthless. When loans become worthless, funds can't repay investors, and that's the cascade everyone is worried about.
Really interesting last global story. Thank you for having me in this podcast and looking forward for the next episode in 2 weeks.
Thanks Manon for the questions today. We covered a lot of ground, from a Belgium scale up making textbook capital structure decision to a $40 billion IPO that could put Belgium on the global financial map, to a deep dive into who's actually driving M&A activity in this country, and finally, for the global part, some genuine warning signs in the private credit market that are worth watching closely. Hopefully, you walked away with a clearer picture of what's moving in corporate finance right now, both here in Belgium but also globally. And if you are a student, hopefully with a few interview ready insight as well. If you enjoy the podcast, the single best thing you can do to help the show grow is leave us a 5-star rating. And just a heads up on how to do it, you need to go to the page of the show itself, not the individual episode. Once you're there, click on the 3 dots and you will find the option to rate it. It takes about 10 seconds and it makes a real difference for getting the show in front of more people. We would also like to hear from you. If there is a topic you want us to cover, something you think we could do better, or anything you want to share with us, drop a comment. All feedback is really welcomed, whether it's a suggestion, a question, or a criticism. And if you would rather reach out more directly, you can find us on LinkedIn. We'll be back in 2 weeks with more Belgium and global corporate finance news. Until then, thanks for listening and have a great week.